Hi, I'm Grant Mundell, investment specialist with Equity Trustees with our July monthly review. Equities rallied over the month with the ASX 200 surging 2.4% and the MSCI World Index jumping around 3.1% in Aussie dollar terms. The US tech sector was once again the main source of strength in international markets. Within the Australian share market, a key theme was the rotation out of Commonwealth Bank into CSL and the resource companies. Talk of Chinese stimulus and the anti involution campaign, which is designed to address excessive competition and eliminate outdated capacity, especially within coal and lithium within China, positively impacted commodities and therefore resource names. The best performing sectors in the ASX were healthcare, energy, and utilities. Property, or A-REITs, also rallied up about 3.3%, outperforming global REITs to be up nearly 10.5% over the last 3 months. The ASX heads into reporting season in August, but the second quarter reporting season in the US is already underway. So far, the results have been solid, and as at the 7th of August, 80% of companies that are reported had beaten market expectations versus a typical average of around 76%. IT companies continue to deliver very strong results and increasing artificial intelligence capex, whilst earnings growth for the quarter is currently forecast to be up around 12% higher year on year. Bonds sold off marginally, while Australian credit markets also rose. Solid domestic economic data and improving consumption trends were supportive for credit markets. Issuance has been increasing and liquidity has been improving. From a macro perspective, the US economic data was sound, and despite a couple of dissenters, the US Federal Reserve kept rates unchanged, while President Trump's stoush with the outgoing Federal Reserve Chair Powell continued. The US announced tariff deals with a range of countries, which has shifted the average US tariff rate higher, up towards 16%. That's a market increase from around 2.5% at the beginning of the year. Domestically, the RBA surprised the market by holding interest rates steady at 3.85%. Economic data was broadly resilient. However, later in the month, markets moved to price in a rate cut in August after Australian year-on-year inflation fell to 2.1% in June and the unemployment rate rose to 4.3%. Markets are now pricing in around 2 to 3 rate cuts in Australia over the next year, which is supportive to the outlook for household consumption. Retail sales and credit growth data were both strong. Consumer and business sentiment is slowly picking up, real income growth is improving, and house prices are rising. As we enter the June 30 reporting period, earnings growth is expected to fall for the Australian market by around 3% year on year for fiscal year 25 before rebounding a few percent in fiscal year 26. Earnings revisions have remained marginally negative while the market has remained strong, driven by higher market multiples, which therefore leaves us a little bit cautious on the equity market in the near term. I'll be back next month with a review for August.